The US deficit as a percentage of GDP now stands at 7.21%, a huge jump from last year, which was 4.68%, reflecting an increasing reliance on debt to sustain US economic activity. With expenses totaling $6.8 trillion and a $1.9 trillion deficit estimated for year-end, it's clear that government spending is outpacing revenue significantly. This raises the question, is US growth increasingly dependent on debt? Overwhelmingly, yes. Over the last decade, U.S. economic growth has often been supported by deficit spending through periods of economic stimulus, like during 2019, but also during periods of economic expansion. The U.S. has relied on government borrowing to fuel growth when private sector activity is weak, but also when private sector activity is robust. Our final strike for Q2 GDP was 3%, and our deficit is still 7.2%. Said differently, we are in economic growth mode, but we're spending like we're in a recession. This approach is completely unsustainable in the long term, as interest payments on our growing debt consume an increasing portion of the budget. A widening deficit also has inflationary effects, and those are very clear, especially when it coincides with high demand and tight supply conditions. The government borrows more to fund spending, increasing demand in the economy. And when this borrowing leads to more money in circulation without a corresponding increase in productivity, it pushes prices higher. In the case of the U.S., the inflationary environment seems to be reaccelerating. This morning's CPI came in higher than expected, with headline CPI pushing 0.2% month over month versus the plus 0.1% month over month expectation, and core CPI came in plus 0.3% versus the plus 0.2% expectation, which suggests that the combination of strong government spending and other economic factors like wage growth is adding to inflationary pressures. And you're starting to see the market price this in as well, with the 10-year U.S. Treasury yield now up 35 basis points since the Fed cut interest rates, and gold soaring higher as well, reflecting higher growth and inflation expectations. To top it all off, the Fed just cut rates by 50 basis points, signaling monetary easing. And the government's high level of spending paired with this could keep inflation elevated and reaccelerate it rather than letting it fall back down to its 2% long-run target set by the Fed. While lower interest rates boost borrowing and spending, they're also counteracting efforts to bring down inflation by increasing demand. So why does the deficit keep widening? Well, there are several reasons. For one, and we know a very big one, is entitlement programs. Programs like Social Security, Medicare, and Medicaid are large drivers of spending. And with an aging population, these costs are growing, and with a declining fertility rate, we have no idea how we're going to keep paying them. Hence, we increase our debt issuance schedule. We also have massive debt servicing costs. If you'll take a look here, rising interest rates over the last 2.5 years have increased payments on the national debt from roughly $0.6 trillion annually to its current $1.09 trillion annually, and a projected $1.6 trillion annual interest expense by the end of the year. Even with the recent rate cut, the existing debt burden remains huge. This further widens the deficit, and our government annual interest expense on our own debt is now the biggest line item on the U.S. Treasury's balance sheet, higher than our national defense spending. We also have slower revenue growth. So while the economy is growing, revenue isn't keeping pace with government spending. And last but not least, the reason why this will never be fixed is because of the political stalemate that it incurs. Structural reforms to address deficit spending, like entitlement reforms and tax increases, are politically difficult, if not impossible, to implement, leaving the deficit to grow unchecked. No politician will ever get reelected or elected if their platform is, I'm going to spend less for my constituents. So while the economy grew 3% in Q2, a great deal of this is due to government spending or credit expansion rather than organic, productivity-driven growth. Relying on debt to fuel growth is risky, as it makes the economy more fragile and more interest rate sensitive. If interest rates rise again or credit dries up, growth could slow very quickly. This dynamic is why I view, and many others, view deficit-driven growth as unsustainable without significant structural reforms or a pivot to productivity-led growth. So if you're looking for a way to insulate yourself from this, of course, we'd advise Bitcoin. And the best way to store your Bitcoin is with Theia. Theia is the world's simplest Bitcoin multi-sig solution, offering simple single-sig and multi-sig Bitcoin vaults for you, your loved ones, and family members. If you'd like to try it out today, visit theia.us or app.theia.us to check out our web app and get yourself set up with a simple and robust Bitcoin security solution today. That's all for today's video. Thank you so much for watching, and I'll talk to you guys tomorrow. Take care.